Hi, I'm Mark Simpson. And since many of us are on lockdown at the moment and not attending many events, then I thought I would continue my quest to bring the Invest event to you by giving an online version of one of my talks. In this case, it's called The 3 Biggest Mistakes Even Smart Investors Make. So let's dive right in. I think the first mistake that investors make is forgetting to play to their own personal strengths. And to understand why I think this is the case, I want to talk a little bit about a concept called competitive advantage. Here's what investor and billionaire Warren Buffett has to say about the importance of competitive advantage. He says the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. And because of this understanding, a lot of effort has gone into understanding what competitive advantage looks like in corporate situations. Here I have a Venn diagram. I think my audience are the type of people who appreciate a Venn diagram, which explains what a corporate moat or a sustainable competitive advantage looks like. And it's the intersection of things that are valuable, that the market wants, that the company is good at, and is hard for competitors to replicate. If a company's good at something and it's hard to do, but it's not valuable to the market, then that's going to be waste. Equally, if the company is not very good at something, but it's valuable and hard to do, that company will be a failure. Slightly better is if a company is good at producing something that's valuable, it will have a competitive advantage. But unless it's hard for other companies to do, then that advantage will be eroded over time through the power of competition. And indeed, companies without a sustainable competitive advantage over the long term will not generate returns above their cost of capital. Sustainable competitive advantages for companies can look like things like brands, network effects, or legal monopolies like patent protection. And this is why investors often look for those features of a company. However, those same investors often forget to apply the same principles to their practice of investing. Markets, financial markets by their nature, are competitive. And if you want to return or generate returns above average, you need a sustainable competitive advantage as an investor. So it needs to be something that's valuable, and clearly being a good investor is valuable. You need to be good at it, so you do need to have good analytical skills and the ability to analyze company balance sheets and things like that. But that alone is not enough to give you excess returns. You need to find places where it's hard for other investors to muscle in on your returns. And to expand on this, I want to look at a little bit of what are not sustainable competitive advantages for an individual investor. So here we go. I think that all of these are not things that are sustainable competitive advantages for the smaller guy. And these are the reasons why. So the first is speed. So although you might be a quick decision maker, in a high frequency trading world, microseconds are the norm for trading. Artificial intelligence can read economic results such as GDP results or interest rates faster than you can blink. And it will have put on trades or reacted to those very, very quickly. Equally, I don't think intelligence is a sustainable competitive advantage. most investors are very intelligent people, but in this case, the returns go to the most intelligent people, and it's unlikely that you're the most intelligent person ever to trade stocks. Equally for work ethic, although you need to work hard and you need to spend time on analysing your investments, but that alone won't deliver you a competitive advantage because it's something people can replicate. A firm can just hire more analysts. So there's a limit to how many hours in a day that you can physically spend on your investing, whereas a firm can simply hire more analysts to outwork you. Equally, gut feel, and while I don't doubt some people have a good gut feel for the markets, it's really hard to know whether this continues to work. The markets are adaptive, things change, and you can lose a lot of money if your gut feel fails you. Essentially, all of these are not competitive advantages because they can be replicated. But I think there are some things that are sustainable competitive advantages for individual investors. These are things like investing in smaller companies or thinking longer term than the market. And this is because of the structure of the market, professional market participants. Professional fund managers are unable to invest in the smallest of companies, which means they cannot put lots of analysts, lots of work hours into analysing the smallest companies. Equally, the business case for having professional research into the smallest of companies is increasingly not a good deal for those investment houses. So therefore, they stop producing research. It doesn't mean that every small company will do well, but it does mean that if you're prepared to put the hours in to analyse a smaller company, you can have a sustainable competitive advantage. Conversely, if you invest in something like BP or Shell, it's unlikely that you know more than every other investor, the hedge funds, the brokers, the investment research houses. So that although those may prove to be good investments, you personally are unlikely to have a sustainable competitive advantage in that space. Likewise, thinking long term, most funds receive bonuses for short-term performance. If they outperform the market in any given year, they receive a bonus. So therefore, their focus is always on next year's bonus. And even more severely, fund managers that underperform for several years often get fired. So the incentive structure of the market in professional funds says outperform slightly, don't underperform. And therefore, that leads to those type of investors thinking unduly short term. If you, as an individual investor, don't have those restrictions, that can form a sustainable competitive advantage for you. Finally, I think special situations can form a competitive advantage. And these, what you're looking for here is times where other market participants are selling stocks for reasons that are not related to the fundamental value of those stocks. The classic example is spin-offs, and Joel Greenblatt wrote a very good book about investing in spin-offs. But I think recently, in current market conditions, the coronavirus has caused liquidity-driven selling. People are selling their stocks for cash at any price, and that can lead to opportunities. It doesn't mean that every stock is a buy when it falls, but in these type of markets, you can find bargains. Stocks that maybe are trading less than the cash on their balance sheet, for example, or have been sold off because people have stops in place, and those stops are triggered and causing a cascade downwards of the stock price below what the conservative estimate of fundamental value would be. You've seen this particularly with risk parity funds blowing up and over the last few weeks as well, adding to the selling. So now could be a good opportunity, if you have spare cash, to look for those undervalued bargains. So that brings the first mistake that I think investors make, and moving on to the second one, I think, is that often investors fail to overcome their weaknesses. And what are those weaknesses? Well, we're going to look at something called behavioural biases, and these are things that we all have, and they're ways in which our decision making is consistently flawed due to how our brains work. And in the literature on this topic, then they often talk about system 1 and system 2 thinking. And I'm going to introduce quickly what those are. System 1 is a way we make decisions, which is fast, reactive, always on. However, it's often wrong about complex scenarios. It jumps in. It produces a very quick answer to any question or decision or quiz that we might face. Here's a classic example from the academic literature on this topic. A bat and a ball costs £1.10. The bat costs £1 more than the ball. How much does the ball cost? So if you're anything like me, your system 1 thinking will take £1 away from £1.10 and immediately jump in and say, oh, it's 10p. However, that system 1 would be wrong. If you do the maths, then because the bat costs £1 more than the ball, you can do the calculation or solve the equation and show that actually the bat costs £1 and 5 pence, which is £1 more than the 5 pence that the ball costs. And being able to do that calculation is part of system 2 thinking. And system 2 thinking is slow, it's more thorough, but worryingly, it's harder to engage. It uses more brain power, it uses more energy. So our brains don't like to use the system 2 thinking unnecessarily. So often we rely on the quick reactive system 1 thinking. However, investing lives in, or successful investing lives in, our system 2 thinking. It requires analysing company accounts, reading management commentaries, assessing the quality of management, assessing the quality of products, and that sort of thorough, detailed engagement requires system 2 thinking. So maybe the key to avoiding mistakes is just to engage our system 2. And that would be the case apart from one problem. And here we go. This is a quote from Daniel Kahneman, who is a psychology researcher, and he actually won the Nobel Prize for his research into these behavioural biases. And when somebody in an interview asked him if all of his research made him a better decision maker, he said, no, not at all. I'm just better at detecting other people's mistakes rather than my own. And here we see the problem, is that in order to engage our system 2, we already will have had to override the instinctive and immediate answer that our system 1 has produced. And we find that very difficult to do. And it's not like we can say, okay, at this point I'm doing system 1 thinking, or this point I'm doing system 2 thinking, because it's not like separate areas of our brain that do this. So this is just a model that describes how we tend to work. And this means that it's very hard to overcome these behavioral biases simply by thinking about them or thinking more about our decisions. So maybe all is lost and we're forever doomed to poor decision making. Well, I think there's some good news actually. And this is because the behavioral biases mean that although we are irrational in our decision making, we are predictably irrational, which is the title of a good book on the topic by Dan Ariely. We can overcome our mistakes, and we can do it by setting rules where we know we're most likely to be predictably irrational. And if you think this is unusual or there's no precedent for this, you'd be wrong, because pilots and surgeons who are experienced, clever specialists with immense training all use checklists and rules every day to avoid preventable mistakes in their area. And you can do the same for your investing. Good investing rules can include things like stop losses or portfolio limits. And my book takes you through some of the rules that you can use to overcome behavioral biases and also how best to implement them. So that's the second mistake that I think a lot of investors make. The third mistake, I think, is focusing only on stock selection. And I understand why, as a stock picker, stock selection is particularly interesting. You are learning new information. You are talking to management teams. You often visualize the profits you're going to make from a successful investment, whereas portfolio management just often sounds a little bit boring. But actually, it really matters. It really makes a difference to your investment performance. And at its heart, portfolio management is about how many stocks you own, when you buy and sell, but perhaps more importantly, how much of each of your stock picks you should own. And there's some popular methods that investors use to weight stocks in their portfolios. But I think a lot of them have some significant disadvantages. So I'm going to go through some of the more popular ways of doing that and why I think they often fail. So the first one is called market capitalization weighting. So this is what indexes use to weight stocks, which means that if a company has twice the market capitalization of another company, the index will own twice as much of the larger company. And this has some advantages. It doesn't need rebalancing because any price movements will automatically rebalance the index to the same or the weighting that the index should be. Market capitalization weighted indexes are self-rebalancing. But there's some problems with it. The first is that by definition, a market capitalization weighted index overweights overvalued stocks and underweights undervalued stocks. That's because an overvalued stock has a share price which is higher than fundamental value, but because the share price is higher, that means the market capitalization is higher, and it means its weighting in the index is higher, and vice versa for undervalued stocks. This is exactly the opposite that you'd want to have if you were a stock picker. And it's also why fundamental indexes, which use sales or profits to weight the index, are increasingly popular. And although that's good for indexes, I think that even then there's some reasons why individual stock pickers would not want market capitalization weighting. This is because a 100 billion market cap company would have 100 times the weighting of a 1 billion market cap company. And if you were a stock picker, those sort of variations are not very useful for you. Right, let's move on to the second one. And this one is a form of portfolio optimization that was created by a guy called Harry Markowitz. In 1952, he wrote a groundbreaking paper explaining how rational investors would want to seek to maximize their volatility adjusted return. And if you knew the expected return and the expected covariance of your investments, i.e. how correlated with each other the price movements of those investments were, then you could create a portfolio which ends up on what's called the efficient frontier. And here we see the bullet shape on the graph there is what's known as the efficient frontier. Also, if you knew the risk-free rate at the moment, then you could create a tangency portfolio, and that would be the best possible outcome for your portfolio, the best possible weighting that would give you the highest return for the least amount of volatility. And although the theory is a good one, there's some issues with it. So the first is the complexity that is needed. In Markowitz's, when he wrote the paper, he wasn't able to actually optimize for many assets. The computing power at the time didn't allow those calculations to be done effectively. And, perhaps tellingly, Markowitz himself didn't use his formulas to optimize his own portfolio. He ended up investing 50-50 in stocks and bonds, at least in the early days. These days, with modern computing, it's possible to calculate where the efficient frontier lies. But again, I don't think most investors would want to. And the reason is that you need to know the expected returns and the expected covariances of your stocks. And although I think most individual investors have a good idea of what their most undervalued stocks are, that doesn't translate easily into an expected return over, for example, the next year. Likewise, correlations between stocks, although they can be measured using historical data, they change rapidly. And in the current markets, I think there's people will have found that correlation has actually increased. There is a saying that in a market crash, the only thing that goes up is correlation. So in reality, you don't really know what the expected returns or the expected covariances are of your stocks. So therefore, anything you put into some form of Markowitz portfolio optimization will be both complicated but also not very correct. The third type of weighting that most people use is equal weighting. So this, compared to the other two that we've just discussed, has a significant advantage, which is quite simple to implement. You just put the same amount into every stocks of your stock picks. But again, I think there is an issue with this. So people who use equal weighting often say it's a form of strategic ignorance. They don't know which of their stock picks will do best, so they choose to have the same amount in all of them. And for me, this is a paradox, because those people are often so certain about which stocks go into their portfolio. They've chosen 20, 30, 40, 50 stocks, and they're very certain that these are my best stock picks. These are the ones that I want to hold. Yet they're so uncertain about which will do best out of those stock picks. And that paradox, I think, is why equal weight is not ideal. If you can even slightly adjust your portfolio towards the stocks that you think are actually your best stock picks, then you will do better than using equal weight. I think it has its place, particularly for those who hold a large number of stocks, maybe 100 or more, or those who follow a sort of sampling method. So they know that a certain factor, such as value, will outperform, or they believe it will, and they want exposure to that factor. So they take a sample of stocks which are positively rated on that factor, and they hold them with some kind of periodic rebalancing. So I think equal weight has its place, but for your average stock picker, it's less than ideal. So what is ideal? Is there a better way? And I think there is a better way. I think it's one that's simple enough to apply to most portfolios. Yet, if you're a reasonable stock picker, then it should beat an equal weight portfolio of your stock picks. However, I'm not going to reveal that now, and if you want to find out what that is, then do pick up a copy of my book. It's available on Amazon, so you should be able to get it in whatever region you're in. If you've already picked up a copy, thank you very much. I really appreciate it. But please do leave me a review on Amazon. It will help other people discover it and learn about it. Also, please subscribe to my channel. I'm hoping to create some more videos like this in the future. And if you have any questions or want other book recommendations, then please check out my website. Email me or follow me on Twitter on what will be appearing on the screen now.